The Wealth Creation Alliance bullish strategies utilize the MACD, major trend, and intermediate term trend systems to identify buy and sell signals for stocks and call option purchases. When the trend systems indicate a price uptrend, traders can initiate three types of limited risk bullish trades: purchasing stocks, purchasing call options, and bullish option spreads. For stock and call option purchases, I use the major trend system for longer term purchases, the intermediate term trend system for medium term purchases, and the MACD for short term purchases. Now, as a general guideline, the major trend system would be used for trades of 6 to 12 months or longer, the intermediate term trend system for trades of 3 to 6 months, and the MACD for trades of 1 to 3 months. Now, many times I will purchase a stock or call option after a buy signal occurs with the moving average crossovers, and then use the money management guidelines presented in Chapter 1 of the Wealth Creation Members Only Guide to sell a stock or call option or a reverse sell signal, whichever occurs first. So we want to purchase stocks and call options when the MACD, major trend, or intermediate term trend systems indicate a price uptrend, and we want to sell stocks when the MACD, major trend, or intermediate term trend systems indicate a price downtrend, or when following the risk management guidelines presented in Chapter 1 of the Wealth Creation Members Only Guide, which has guidelines for exiting losing trades and exiting winning trades. The historical profit results presented for the major trend and intermediate term trend systems demonstrate that the systems produced impressive profits with very low risk. The three trend following systems will guide you to stocks in a price uptrend and help you avoid stocks in a price downtrend. Now, this gives us a huge advantage over a strategy that tries to pick stocks by trying to predict the future. Now, at any given time period, there can be hundreds of stocks that qualify as a buy using the three trend following systems. The problem lies in trying to narrow down this large list of buys to a manageable number of stocks that you can trade with a limited amount of trading capital. Over the years, I developed several trend confirmation indicators that I'd like to share with you that increase the profit potential and accuracy of a trend following system. In my trading experience, I discovered that stocks that are making a new 52-week high tend to continue their price uptrend. A stock that is making a new 52-week high confirms the price uptrend and allows you to narrow down your buy list to stocks with the greatest profit potential. Now, I normally check the new 52-week high list almost every trading day, and I discovered that when you check this list daily, you start to notice stocks in certain industry groups that make new highs almost daily. These are the industry groups I like to focus on to further narrow down my list of stocks with the greatest profit potential. I will then normally buy one stock or call option from each of the top performing industry groups. Investor's Business Daily newspaper is also a good source for top performing industry groups. Part 2 of IBD currently ranks 33 industry groups and the stocks within the group by relative strength. Quantitative research suggests that approximately 1/2 of a stock's price appreciation is due to the industry grouping of a stock. Now, focusing on the top performing industry groups provides a constant tailwind to your trading success. It allows you to not only narrow down your list of stocks, but also provides you stocks with the best profit potential. The price graphs that I'm displaying now are good examples of stocks that I traded that were in top performing industry groups and trading at new 52-week highs. Notice that these stocks have been frequently making new 52-week highs, providing many good buying opportunities. Here are two more examples of stocks in a price uptrend with trend confirmations. Now, the top performing industry groups are constantly changing, and these industry groups being displayed may change by the time you view this segment. Now let's take a look at some actual trade examples of stocks I purchased that were in a price uptrend with trend confirmations. This brokerage confirmation shows that I purchased 134 shares of Matrix Service Company. I used the major trend system and intermediate term trend system, which were on a buy signal, combined with the 52-week high trend confirmation indicator to select this stock for purchase. And in this trade example, I purchased 600 shares of Alpha Natural on April 8th, shortly after the MACD crossed above the 18-day EMA, indicating positive price momentum. The price trend was also confirmed as Alpha Natural made a series of new 52-week highs, and Alpha Natural was in a leading industry group. And this brokerage profit loss report shows that I purchased 600 shares of Walter Industries. I used the major trend system and intermediate term trend systems, which were on a buy signal, combined with the 52-week high trend confirmation indicator to select this stock. This trade produced a $10,019 profit after commissions and fees. Let's take a more detailed look now at call option purchases. We want to utilize the three trend following systems to identify buy and sell signals for call option purchases. When the MACD major trend or intermediate term trend system indicates a price uptrend, traders can purchase call options. We also want to use the same 52-week high and leading industry group trend confirmation indicators just presented to find stocks with the best profit potential for call option purchases. And we want to sell call options when the MACD major trend or intermediate term trend systems indicate a price downtrend, or when following the risk management guidelines presented in Chapter 1 of the Wealth Creation Members Only Guide. Now, as a general guideline, I use the major trend system for call option purchases with 6 to 12 months or longer until option expiration, and I use the intermediate term trend system for call option purchases with 3 to 6 months until option expiration. And I use the MACD system for short-term trades with 1 to 3 months until expiration. Now, if I purchase a call option on a stock after a buy signal occurs, which is the crossover of the moving averages, then I use the money management guidelines presented in Chapter 1 of the Wealth Creation Members Only Guide for exiting losing trades and exiting winning trades. My brokerage account portfolio statement that I'm displaying now shows examples of call options I purchased using the MACD major trend or intermediate term trend systems, combined with the 52-week high and leading industry trend confirmation indicators. As you can see, this call option portfolio has a $254,000 profit and an average return of 114% with no losing trades. Now, in this portfolio, I traded as many as 24 option contracts. Trading one contract would require considerably less trading capital for smaller trading accounts. Let's take a look now at some actual call option purchases and the criteria I used to select these trades. This brokerage confirmation shows I purchased 15 of the Apple October 130 strike call options at 14 points. I used the major trend system and intermediate term trend system, which were on a buy signal, combined with the leading industry and 52-week high confirmation indicators to select this option. In this trade example, on April 23rd, I purchased 10 of the Express Scripts June 80 strike call options after the MACD crossed above the 18-day EMA, indicating positive price momentum. The price uptrend was also confirmed as Express Scripts made a series of new 52-week highs. And in this trade example, I purchased 10 of the FCX June 65 strike call options using the major trend and intermediate term trend systems, which were on a buy signal, combined with the leading industry and 52-week high trend confirmation indicators to select this option. Let's take a look next at the details of the 3 call option trade examples just presented so that you can understand the important concept of leverage and how leverage can provide a high rate of return. Remember that even though these call option trades use leverage, they are all limited risk trades and you can't lose more than your initial investment regardless of adverse market moves. My brokerage account profit loss report shows that on August 31st, I purchased 15 of the Apple October 130 strike call options, symbol APVJF, at 14 points. These options expire in about 6 weeks. And then on October 5th, I sold the 15 Apple call options at 30.30 points, resulting in a $24,000 net profit after commissions and a 116% return for the option trade. Now on August 31st, when I purchased the Apple options, Apple stock was trading at 139.20. And when I sold the options on October 5th, Apple stock was trading at 158.40. Now purchasing Apple stock at 139.20 on August 31st and selling on October 5th at 158.40 would result in a 13.8% return for the stock. Over the same time period, my option trade produced a 116% return, which is 8.4 times greater than the stock trade, demonstrating the leverage available from trading options. These brokerage account confirmations display the FCX and Express Script call option purchase examples previously presented. I purchased 10 of the FCX June 65 strike call options at 7.20 points and 10 of the Express Script June 80 strike call options at 10.18 points. And my brokerage account profit loss report shows that I sold the FCX calls at 16.35 points and the Express Script calls at 22.40 points. This resulted in a $9,000 profit and a 126% return for the FCX calls and a $12,000 profit and a 119% return for the Express Script calls. Over the same time period, purchasing FCX stock would have produced a 14.8% return compared to the 126% return for the option. In this example, the option purchase provided 8.5 to 1 leverage compared to the stock purchase. And purchasing Express Script stock would have produced a 15.4% return over the same time period compared to the 119% return for the option. The option purchase in this example provided 7.7 to 1 leverage compared to the stock purchase. Now, on average, these three option trade examples for Apple, FCX, and Express Scripts provided more than 8 times more profit compared to the purchase of their underlying stocks over the same time period. The 8 to 1 leverage provided by options can dramatically increase profit results. Let's have some fun and take a look at historical profit results for trading options instead of stocks using the major trend system. Historical results are based on purchasing call options for major trend buy signals and purchasing put options for sell signals. Although the real-time trade examples just presented provide more than 8 to 1 leverage, let's assume for this historical study that the option trades only provide a more conservative 4 to 1 leverage compared to the stock trades. Results are theoretical as options were not available for some stocks at the beginning of the test period. I conducted historical option testing on the same diversified portfolio of 8 stocks that were presented previously. The historical profit results are based on an initial investment of $4,600 divided equally among the 8 stocks in 1998, compounding the results thereafter, and do not include commissions. Now, I chose the $4,600 initial investment because I started my options trading career in 1984 with a $4,600 trading account. Now, looking at the historical profit results, we can see that the major trend system produced tremendous profits trading options with very low risk. A $4,600 investment in December of 1998 produced a net profit of over $17 million before commissions. This equates to a 383% total return on the initial $4,600 investment. Over the 10-year test period, this translates to more than a 38,000% average annual return. Like I said, we're having fun. These results are just theoretical, but they can give you an idea of how 4 to 1 leverage can dramatically compound your profits. All test years were profitable. Trading options using the major trend system produced $17,670,000 in total profits and $44,000 in total losses. Dividing the total profits by the total losses results in a profit-to-loss ratio of 401 to 1, which equates to more than $400 of profit for each $1 of loss. The profit-to-loss ratio is a good measure of risk. As noted previously, a high profit-to-loss ratio indicates that the major trend system keeps losses to a minimum by exiting losing trades before they develop into big losses. These profit results highlight one of the big advantages of the major trend system of taking both long and short trades. The ability to take short trades increases the diversity and profit opportunities of the system. Now, once you decide to purchase a call option, you must then decide on an option time length until expiration and a strike price. For many stocks, there are literally hundreds of options to choose from with different expiration dates and strike prices. How does the trader effectively choose an option with the best profit potential from several hundred choices? While stock selection is important for successful call option trading, in my experience, selecting the time length and strike price is just as important as selecting the stock itself. Chapter 6 of the Wealth Creation Members Only Guide provides criteria for selecting time length, and the call option purchase calculator is helpful in analyzing the profit loss potential for various strike prices. This can help you select a strike price that is suitable for your own personal risk tolerance. This strike price analysis can be done prior to purchasing a call option. There are instructions on using all of the wealth creation strategy calculators included in the Wealth Creation Members Only Toolbox Manual. Let's look at how we can use the call option purchase calculator to help us select a strike price. We will look at examples of an out-of-the-money and an in-the-money call option purchase. Let's look at an example of purchasing an out-of-the-money call option first. This quote table contains option quotes for Tesoro Corp stock, symbol TSO, courtesy of Yahoo Finance. Tesoro is currently on an MACD and an intermediate term trend system buy signal. Let's focus on the May 20 strike call option, symbol TSO-ED, which expires in about 3 months. This option is currently trading at 1.70 points. Now, option contracts normally cover 100 shares of stock. If we purchase one May 20 strike call option at 1.70, we would pay $170 plus commission. The value of this call option on option expiration day would be determined by the price of Tesoro stock. Tesoro stock is currently trading at $17.56. Purchasing the 20 strike call option would be considered an out-of-the-money option, as the 20 strike price is greater than the current Tesoro stock price of $17.56. An out-of-the-money call option consists of only time value, and in this example 1.70 points, and it has no intrinsic value. If Tesoro stock closes at 20 or below at option expiration on May 15th, then this option would expire worthless. To access the call option purchase calculator, log on to the member section of the Wealth Creation Alliance website and click Call Option Purchase. There are 4 inputs that need to be typed in for the call option purchase calculator to generate a return analysis. And in this example, we want to type in stock symbol of TSO, stock price of $17.56, an option strike of 20, and the option premium of 1.70. Then in the percent change row, which is the first row of the calculator, type in your desired price percentage change for Tesoro stock at option expiration. This row is a user input and can be changed to any desired percentage change. In this example, I chose a range of percentages from a plus 20% to a minus 10%. Then click Calculate, and the calculator will calculate the profit loss potential for this option. The calculator will calculate the time value and intrinsic value for the option. In this example, the time value for the Tesoro 20 strike call is 1.70 points, and the intrinsic value is 0, as out-of-the-money calls consist of only time value. The call option purchase analysis displays the profit potential for this call option purchase, assuming various price changes for Tesoro stock at option expiration. The first row of the table is labeled percentage change, and again, this is a user input. In this example, we're assuming various percent changes in Tesoro stock at option expiration, from a 20% increase to a 10% decrease in price. The second row is labeled stock price and is the Tesoro stock price that corresponds to the percentage change listed on the row above. The option value row lists the value of the call option, which corresponds to the price of Tesoro stock. The rows labeled profit loss and percentage profit loss list the point profit or loss and the percentage profit or loss for the option. The maximum risk on this trade is $170, which is the cost of the option. There is no limit on the profit potential for a call option purchase. The analysis reveals that if Tesoro stock increases 20% to 2107 at option expiration, a 36% option loss would be incurred. Now I circled this in the first column of the analysis for you to see. And if Tesoro stock price remains flat at 1756, a 100% loss would be realized for the option. Again, this is circled. And a 10% decrease in Tesoro stock to 1580 would also result in a 100% option loss. Tesoro stock would have to increase more than 23% at option expiration in order for this trade just to break even. Now, in general, this option doesn't have a very good chance of being profitable and would require a large price move in Tesoro stock at option expiration just to break even. This out-of-the-money call option purchase analysis reveals that out-of-the-money call option purchases are highly leveraged. A 10% increase in stock price can result in a 100% option loss. A flat or small decrease in stock price can also result in a 100% option loss. Risk is limited to the cost of the option. The profit potential is unlimited, and the underlying stock must have a substantial increase in price in order for this option to profit. Now let's take a look at purchasing the Tesoro May 10-strike call, symbol TSOEY, which according to the option quote previously presented is trading at 810. The 10-strike call would be considered an in-the-money call as the strike price is lower than the current stock price of 1756. There are 4 inputs that need to be typed in for the call option purchase calculator to generate a return analysis for this in-the-money call option. We would type in the stock symbol TSO, stock price of 1756, option strike of 10, and the option premium of 8.10. Then in the percent change row, which is the first row of the calculator, type in your desired price percentage changes for Tesoro stock at option expiration. This is a user input and can be changed to any desired percent change. In this example, I chose a range of percentages from a plus 20% to a minus 10%. Then click Calculate, and the calculator will calculate the profit loss potential for this option. Now the calculator will also calculate the time value and intrinsic value for the option. In this example, the time value for the Tesoro 10-strike call is 0.54 points, and the intrinsic value is 7.56 points. In this example, the 0.54 time value equates to only 3% of the Tesoro stock price of 1756. Now in Chapter 6 of the Wealth Creation Members Only Guide, it's recommended that you limit the time value of an option purchase to 1% of the stock price per month. In this example, the 3% time value of the 10-strike call over the 3-month period until expiration does meet the goal of limiting time value to 1% per month. The calculator will also calculate the time value and intrinsic value for this option. In this example, the time value for the Tesoro 10-strike call is 0.54 points, and the intrinsic value is 7.56 points. In this example, the 0.54 time value equates to only 3% of the Tesoro stock price of 17.56. Now in Chapter 6 of the Wealth Creation Members Only Guide, it's recommended that you limit the time value of an option purchase to 1% of the stock price per month. In this example, the 3% time value of the 10-strike call over the 3-month period until expiration does meet the goal of limiting time value to 1% per month. The call option purchase analysis displays the profit potential for this call option purchase, assuming various price changes in Tesoro stock at option expiration. The first row of the table is labeled percent change and assumes various percent changes in Tesoro stock at option expiration, from a 20% increase to a 10% decrease in this example. The second row is labeled stock price and is the Tesoro stock price that corresponds to the percentage change listed on the row above. The option value row lists the value of the call option, which corresponds to the price of Tesoro stock. The rows labeled profit loss and percentage profit loss list the point profit or loss and the percentage profit or loss for the option. The maximum risk on this trade is $810, which is the cost of the option. There is no limit on the profit potential of a call option purchase. The analysis reveals that if Tesoro stock increases 20% to 2107 at option expiration, a 36% option profit would be realized. Now, I circled this in the first column for you to see. And if Tesoro stock price remains flat at 1756, a 6.7% loss would be realized for the option. A 10% decrease in Tesoro stock to 1580 would result in a 28% option loss. Now, Tesoro stock would have to increase 3% at option expiration in order for this trade to break even. Now, just to recap, this in-the-money call option purchase reveals in-the-money call option purchases are moderately leveraged, and a 10% increase in the stock price results in a 15% option profit. A flat stock price results in a small 6.7% option loss. Risk is limited to the cost of the option. The profit potential is unlimited, and the underlying stock only needs a small increase in price in order for the option to profit. Let's now review the differences between in-the-money and out-of-the-money call option purchases. We can see from the preceding call option purchase examples that the in-the-money call option purchase will produce a reasonably good profit with a moderate 10 to 20% stock price increase. The in-the-money option only has 1/2 point of time value. Tesoro stock would only have to increase by 1/2 point by option expiration for this trade to break even. A flat stock price would result in a 6% loss. Compare this to the out-of-money call option purchase, which would result in a total loss of your investment with a flat stock price. A 10% increase in Tesoro stock would also produce a 100% option loss for the out-of-the-money option versus the in-the-money call, which would realize a 15% profit. Tesoro stock would need a substantial 25 to 30% price increase before the out-of-the-money option realizes a moderate profit. The odds of this type of price move occurring on a regular basis are very low. These trade examples clearly demonstrate that investing in the money call options can reduce the overall risk of option investing. With a 3% break-even price, the in-the-money option has a much higher probability of being profitable than the out-of-the-money option with a 23% break-even. The in-the-money call option purchase strikes a good balance between reward and risk compared to a higher risk out-of-the-money call option purchase. Remember, at option expiration, an option loses all time value and is comprised of only intrinsic value. An in-the-money call option is comprised of both time value and intrinsic value. The deeper an option is in the money, the more intrinsic value it will have. In this example, the in-the-money option premium is comprised of 7% time value and 93% intrinsic value. An in-the-money option does not require a large upward price move in the underlying stock to break even or to produce a profit, and has a much higher probability of success. Now, the overall goal of the Wealth Creation Alliance program is to maintain a 3-to-1 or better profit-to-loss ratio. You must be able to limit losses if you want to achieve this overall goal. Trading in-the-money options allows us to employ the 20 to 30% loss limit technique presented in Chapter 1 of the Wealth Creation Members Only Guide. This money management technique is not practical when trading out-of-the-money options, as a very small price move in the underlying stock can incur a 100% loss for the out-of-the-money option. Remember that when you invest in options, you must be correct not only about the future price movement of the underlying stock, but you must also be correct about the time frame during which this movement must occur, which is option expiration. You must plan on the possibility that you're not correct about the price movement and/or time frame. If you are wrong about the price direction or time frame, you could lose your whole investment with an out-of-the-money option. This is not an acceptable risk if you want to stay in the game after unanticipated market corrections or price declines. After many years of trying to hit a home run by investing in out-of-the-money options, I realized that this type of strategy was too risky, as I had too many out-of-the-money options expire worthless. No matter how good your stock selection is, there will be periods when you are wrong and cannot afford to risk the total loss of your investment. Now, every trader has a different risk tolerance and must decide if they want to trade in-the-money call options with lower risk but a smaller profit potential, or out-of-the-money calls with a higher risk but also with greater profit potential. Purchasing out-of-the-money call options require a substantial price increase in the underlying stock in order to be profitable and incur considerably more risk than an in-the-money option. As indicated by the trade example just presented, a flat or slightly down price in the underlying stock can result in the total loss of your investment for an out-of-the-money option. Let's now take a look at bullish call option spreads. The Wealth Creation Alliance call option spread strategy utilizes the 3 trend following systems to enter bullish option spreads. When the MACD major trend or intermediate term trend system indicates a price uptrend for a stock, traders can enter call option spreads for that stock. Now, call option spreads profit as the price of the underlying stock increases. Call option spreads can be initiated by purchasing a call option and selling a call option with a higher strike price. The call option purchase and sale can be done simultaneously, or you can leg into the spread by purchasing a call option and selling a call option to create a spread at a later date. In Chapter 7 of the Wealth Creation Alliance Members Only Guide, we explore the technique of legging into a spread. Right now, we will focus on creating an option spread by the simultaneous purchase and sale of a call option. When initiating option spreads, I use the major trend system for longer-term spreads, the intermediate-term trend system for medium-term spreads, and the MACD for short-term spreads. Now, as a general guideline, I would use the major trend system for trades of 6 months to 12 months or longer, the intermediate-term trend system for trades of 3 to 6 months, and the MACD for trades of 1 to 3 months. Many times I will initiate a bullish call option spread on a stock after a buy signal occurs, which is the crossover of the moving averages. I will then use the money management guidelines presented in Chapter 1 of the Wealth Creation Alliance Members Only Guide to close out an option position. I use the same 52-week high and leading industry group trend confirmation indicators covered previously to select stocks for call option spreads. Using the three trend following systems along with the trend confirmation indicators allows us to find the stocks with the best profit potential for call option spreads. Let's look at some actual call option spread trade examples. The copy of my brokerage portfolio statement I'm displaying contains examples of call option spreads I initiated using the three trend following systems combined with the 52-week high and leading industry group trend confirmation indicators. This spread portfolio has a $175,000 profit and an average return of 95%. All trades are profitable. Here is another call option spread example for Apple. My brokerage confirmation shows that on April 3rd, I purchased 10 of the Apple May 85 strike call options, symbol QAAEQ, at 11.60 points, and simultaneously sold the May 95 strike call, symbol QAAES, at 490. This created a bullish call option spread. I used the major trend system and intermediate term trend system, which were on a buy signal, to select this option. Let's now take a look at using the call option spread calculator in analyzing the profit loss potential for the Apple call option spread just presented. The call option spread analysis can be done prior to initiating the spread. To access the call option spread calculator, log on to the member page of the Wealth Creation website and click Call Option Spread. Instructions on using the calculator are included in the Wealth Creation Toolbox manual. The call option spread calculator is helpful in analyzing the profit loss potential for a bullish option spread. Now there are 6 inputs that need to be typed in for this call option spread calculator to generate a return analysis. In this example, we would type in AAPL for the Apple stock symbol. The stock price is 95.20. The buy strike is 85. The buy price is 11.60. The sell strike is 95. And the sell price is 490. Then in the percent change row, which is the first row of the calculator, type in your desired price percent change for Apple stock at option expiration. This is a user input and can be changed to any desired percentage change. In this example, I chose a range of percentages from a 15% increase to a 5% decline. Then click Calculate, and the calculator will calculate the profit loss potential for this call option spread. The second row is labeled stock price and is the Apple stock price that corresponds to the percentage change listed on the row above. The call buy and call sell value lists the value of the long and short call option, which corresponds to the price of Apple stock. The spread value is the net value of the spread and is calculated by subtracting the value of the short option from the value of the long option. The spread cost row displays the cost of the spread, and in this example is calculated by subtracting the 490 points received from the sale of the 95 strike call from the 1160 cost of the 85 strike call purchase. The maximum risk for this trade is $670, which is the cost of the spread. The spread profit row displays the point profit or loss of the spread and is calculated by subtracting the spread cost from the spread value. The spread percentage return displays the percentage profit or loss for the spread and is calculated by dividing the spread profit by the spread cost. Now the spread analysis reveals that if Apple stock increases 10% to 104.72 at option expiration, a 49% profit would be realized for the spread. And if Apple stock remains flat at 95.20, a 49% profit will also be realized. And a 5% decrease in Apple to 90.44 results in an 18% spread loss. Now the maximum profit potential for a bullish call option spread is realized if the underlying stock closes at or above the strike price of the short call option at option expiration. In this example, the maximum profit potential is 49% and is realized if Apple stock closes at or above 95 at option expiration. The profit potential for call option spreads is limited, and in this example, 49% is the maximum profit potential, regardless of how much Apple stock increases in price. This call option spread analysis reveals that the call option purchased profits if the price of the underlying stock increases in price. The call option sold profits if the price of the underlying stock decreases, and from the time decay of the short option. Bullish option spreads can normally profit if the price of the underlying stock increases, remains flat, or decreases slightly. A small increase in stock price can result in a large option spread profit. A flat stock price can also result in a large option spread profit. Risk is limited to the cost of the spread. The profit potential is limited, and the cost of option spreads is normally low, enabling you to trade a diversified portfolio of spreads in a smaller trading account.